Okay, so to begin, interest rates are essentially a fee for borrowing money, and since you can literally borrow money for almost anything and you can borrow many different amounts, there are many different types of loans with different interest rates. So these interest rates kind of serve as the backbone for the Fed's monetary policy, which is how the Fed regulates the U.S. economy and help its growth, hopefully. So kind of overall, interest rates are seen in every area of banking and investing on both the consumer and supplier sides, and it's also how the Fed kind of controls the U.S. economy. So what is the Fed? The Fed was created by Woodrow Wilson in 1913 to be a bipartisan agency that regulates the economy through monetary policy. It was created with the Federal Reserve Act of 1913. So the Fed consists of the FOMC and the Board of Governors. The FOMC is the Federal Open Market Committee, which controls its investments in the open market, obviously. So this is things like the treasury bonds or stocks, treasury bonds, sorry. And it has the Board of Governors. The Board of Governors are basically the people who control the Fed. They decide on interest rates and reserve requirements for banks. So the Fed itself is split into 12 districts, each district having its own Federal Reserve Bank. And the Fed itself has four main responsibilities: to control the nation's monetary policy, supervise and regulate banks to ensure the safety and money of its consumers, maintain the stability of the financial system and contain its risks, mostly inflation. This is done by the monetary policy. And then it's also to provide services to the government, domestic banks, and international banks, most commonly in the form of loans. So I touched on it in the last slide, but the Federal Open Market Committee, more specifically, is the committee in charge of the Fed's open market policy, like I said, the treasury bonds and stuff like that. So how this committee works is there are a total of 12 members, the president of the Federal Reserve Bank in New York, and 7 members of the Board of Governors on the Federal Reserve System are always on it, and then there are four of the remaining 11 Reserve Bank presidents who serve a one-year term and rotate with other presidents in their bank's geographic group. They kind of rotate in and out of those 4 remaining positions. So the FOMC meets 8 times a year to decide on, quote, economic and financial conditions, determine the appropriate stance of monetary policy, and assess the risks to its long run goals of price stability and sustainable economic growth, unquote. So now interest itself. Interest is basically an equation made by smart people to make themselves some money, and there are multiple different types of equations that are used for different results. So to start, to be simple, there is compounding interest and simple interest. Compounding interest really is the addition of the previous term's interest onto the next. So, for example, if you were to have $100 and 10% interest, the first term you'd receive $10 and add that to the initial $10. So for the next term, you'd get 10% interest on $110, and you do that for however many times the loan, or not the loan, but however many times, I guess, the loan is. And then there's simple interest. Simple interest is just when you keep on multiplying the principal by the interest in time. It's mostly used for short-term loans. And then there are different types of loans that have differing rates. So there's the variable rates and the fixed rates. Variable is a rate that depends on the prime rate, so it can change and or fluctuate during the time of the loan. And then there's the fixed loan, where you get one set interest rate for the entire length of the loan. And then there's amortization. So amortization is kind of this way that a loan can be set up, so where you initially pay off your interest first and then your actual loan. It's usually to the benefit of the banks or the lender. So types of interest rates. There are prime rates and variable rates. These are mostly affected for credit cards, but the prime rate is derived from the from the rate banks charge each other for loans in order to meet the Fed's reserve requirement. So every time the FOMC, but every time the Fed meets, they set this reserve requirement that banks must have in order to make sure that if there were a run on the banks, there would be enough money. And so the prime rate is derived from the rate these banks charge each other in order to meet that requirement. And then the variable rate is a percentage above the prime rate that is usually given to consumers. So now we go into nominal, real, and effective interest rates. So these are all different ways to kind of represent a rate, either accounting for inflation or compounding a loan, debt, or investment, or whatever. So nominal and real rates, they're more closely related than the effective is. So kind of the effective rate is the outsider. So nominal rate is the rate before inflation, and the real rate is the rate after inflation. And then the effective rate is the real return on investment, or your percentage owed after compounding is taken into account. So kind of used for different purposes, I guess, but there they are. So business cycle. Interest rates affect the business cycle. What the business cycle is, it is the graphing of a nation's GDP over time. And so what GDP is just kind of a way to represent the output of a nation's goods and services. It can be adjusted for inflation. So in the business cycle, you have recessions and expansions, which kind of indirectly translate to a bearish versus a bullish market. Okay, so interest rates, like I said, they kind of hold a major part in the cycle. So kind of when you have higher interest rates, you don't want to take out a loan because then you'll be paying more money in interest, and so you kind of decrease the nation's spending. But when the Fed lowers their interest rates, this increases spending, because when you have a low interest rate, you're paying less interest, and you're getting more bang for your buck, so to speak. And so this rate I'm talking about refers to the banker prime rate that banks charge each other, or the Fed sets, and that banks charge each other to meet that Federal Reserve, or the reserve amount required. So this effect on the economy and philosophy. So there are several major schools of thought when it comes to kind of how you can control the business cycle with with interest rates and stuff like that. So there's the monetarist, there's the Keynesian, and then the laissez-faire. I have a very hard time pronouncing these. But to start, the monetarist is kind of money supply is what controls the economy. So it says that the biggest factor in controlling the economy itself is the money supply. And it puts a lot of power in the Fed's hands, and it kind of believes that economic prosperity and money supply are like directly related. And then there is the Keynesian, really, really, really hard name to pronounce in my opinion. But this is more so demand side economics. So what believers of this philosophy think is that the economy is best controlled by the government, and they control the supply of all the goods and services. So you therefore manipulate the demand for such products. And you kind of also believe that the market change through monetary policy is slow and not very effective. And then there's laissez-faire, which is just leave the market be and let the natural order of the economy kind of reveal itself. And so government involvement, just no. So these are kind of like the three big philosophies or schools of thought on how to control the business cycle. So the Great Depression. The government and the Fed had a great role in the recovery of the nation's economy in the Great Depression, obviously. So this is more fiscal policy in the New Deal. But the New Deal then brought not the New Deal didn't bring it, but then came World War II. During World War II, rates were at 0.3% for government bonds and at 1% for short-term loans, historical low. I think it dropped from like 1% to 0.3, and then like 3% to 1%, so incredibly low, which then increases spending and allows for the U.S. to shine in its industrial power. And then you have today, COVID-19. So on March 16th, 2020, the Fed announced a move to cut its prime rate a whole percentage point to 0.25%. On that same day, JP Morgan Chase cut their prime rate to 3.25%, a whole percent below their previous rate, 4.25%. The Fed also announced the purchase of $500 billion in Treasury securities and $200 billion of mortgage-backed security bonds over the coming months. And so this is kind of how the Fed is preparing itself for what's going to happen, so to try and limit the effects of this huge recession that we're going to have with COVID-19. So these are kind of my analytical questions. Does the Fed hold too much power? should there be a body put in place to check the actions of the Fed, why or not? And since the Fed is a bipartisan research-based agency, do they deserve a right in deciding fiscal policy, government spending, tax brackets, etc., as well as monetary policy? Why or why not?